The Director of Media Relations here at the Bank of Canada. I'll be moderating this morning's press conference. Governor Macklem and Senior Deputy Governor Rogers will be happy to take your questions until about 11:45 this morning. Macklem will start with some opening remarks, and then we'll get to your questions. Let me just quickly go over the ground rules. There are a lot of reporters here in Ottawa, and we have some on the phone as well today. I will do my best to make sure every outlet has the opportunity to ask one question. Given the attendance, I'm going to ask people to limit themselves to one question to start, and we'll see about getting a second round in if we have the time. Nous avons beaucoup de journalistes avec nous aujourd'hui, donc je vais demander à tout le monde de vous limiter à d'une seule question. Et si nous avons le temps, on peut essayer une deuxième ronde. If I fail to do so, please state your name and affiliation, although I'm pretty good at that. For those in the room, it'll be important for you to press the button in front of you to activate your microphones when asking your question so that everyone can hear you. And for those on the phone line, I'm going to ask you to please be careful with your audio. Unmute your line just to ask your question only, and then as soon as you're done, please go back on mute. And that way we can make sure that everyone will be able to hear both your question and the answer. Et avant de poser une question, veuillez vous identifier et, comme toujours, libre à vous de poser vos questions dans la langue officielle de votre choix. And with that, I'm going to turn it over to Governor Macklem for his opening statement.
Well, good morning. I'm very pleased to be here with the Senior Deputy Governor, Carolyn Rogers, to discuss today's policy announcement and our outlook in the Monetary Policy Report. Our policy decision today has two elements. First, we raised our policy interest rate by 25 basis points to 4.5%, and we are continuing quantitative tightening. Second, if economic developments evolve broadly in line with the forecast we published today, we expect to hold the policy rate at its current level while we assess the impact of the cumulative 425 basis point increase in our policy rate. We've raised rates rapidly, and now it's time to pause and assess whether monetary policy is sufficiently restrictive to bring inflation back to the 2% target. La décision aujourd'hui comprend deux volets. Premièrement, on a relevé le taux directeur de 25 points de base pour le faire passer à 4,5%. Et on va continuer le resserrement quantitatif. Deuxièmement, si l'évolution de l'économie suit la prévision publiée aujourd'hui, on va garder le taux directeur au niveau actuel pendant qu'on évalue l'impact de l'augmentation cumulée de 425 points de base de ce taux. On a haussé les taux rapidement. Il est temps de faire une pause pour voir si la politique monétaire est assez restrictive pour ramener l'inflation à la cible de 2%. At our last two policy decisions, the Governing Council said we would be assessing how tighter monetary policy is working to slow demand, how supply chains are evolving, and how inflation and inflation expectations are responding. These assessments, together with our revised forecast, were important inputs into our policy decision. Recent data suggests that the restrictive stance of monetary policy is dampening household spending, particularly on housing and big-ticket items. But economic growth and employment in the second half of 2022 were stronger than we expected. And so excess demand in the economy has persisted, putting continued upward pressure on prices. Simply put, our overheated economy has not cooled as much as we expected. Global supply chains, on the other hand, are resolving more quickly than expected. And while we're not back to normal yet in Canada, we have seen substantial progress. CPI inflation declined to 6.3% in December, reflecting lower energy prices and some moderation in the prices for durable goods as supply improved and demand softened. Lower gasoline prices are welcome, but prices of essentials like groceries and rent continue to increase too quickly. Measures of core inflation have also been stuck at about 5%. With 3 months rates below year-over-year increases, core inflation will likely start to come down in the months ahead. Still, core inflation needs to continue to decline for total CPI inflation to get back to the 2% target. Regarding expected inflation, our surveys indicate that fewer households and businesses think inflation will stay high for a long time, but short-term inflation expectations remain elevated and are above our own inflation forecast. Based on these assessments, the Governing Council concluded that a further modest increase in the policy rate is appropriate. The bank's ongoing program of quantitative tightening is complementing this restrictive stance. Looking ahead, we know it takes time for higher interest rates to work through the economy to slow demand and reduce inflation. And given the speed and magnitude of the interest rate increases over the last year, their full effect is still to come. We can also see that the interest rate increases we've undertaken to date are already working. Higher interest rates are slowing household spending, and inflation is coming down. With today's modest increase, we expect to pause rate hikes while we assess the impacts of the substantial monetary policy tightening already undertaken. To be clear, this is a conditional pause. It's conditional on economic developments evolving broadly in line with our NPR outlook. If we need to do more to get inflation to the 2% target, we will. We're trying to balance the risks of under and over tightening. If we do too little, the decline in inflation will stall before we get back to target. If we do too much, we will make the adjustment unnecessarily painful and undershoot our inflation target. 2 weeks from now, on February 8th, we will publish for the first time a more detailed summary of Governing Council's deliberations. This summary will provide more insight into our decision-making, so I can be briefer today. But let me say a few words about our economic outlook. L'inflation mondiale reste élevée et généralisée. Dans de nombreux pays, elle a descendu par rapport à son sommet. C'est surtout à cause des prix moins élevés de l'énergie et de la résolution d'une partie des problèmes d'approvisionnement. Aux États-Unis et dans la zone euro, la croissance économique a été plus forte que prévu, mais l'activité ralentit. Les marchés du travail restent tendus. Comme l'inflation est encore bien trop élevée, beaucoup des banques centrales ont continué d'augmenter leur taux directeur pour freiner la demande et faire baisser l'inflation. La Banque estime que la croissance de l'économie mondiale a été proche de 3,5% en 2022 et descendra à environ 2% en 2023 et 2,5% en 2024. L'invasion de l'Ukraine par la Russie crée toujours de l'incertitude, surtout en Europe. En Chine, la levée brutale des restrictions sanitaires est une nouvelle source d'incertitude. C'est un risque à la hausse pour les prix mondiaux des produits de base. In Canada, the economy remains overheated and clearly in excess demand. Tight labor markets have shown only modest signs of easing. Job vacancies have come down a little, but remain elevated. The unemployment rate is near historic lows, and many businesses continue to report labor shortages. But as I said, higher interest rates are working to help the economy rebalance. Household spending has moderated. Demand for furniture and appliances has decreased, and housing market activity and prices have declined substantially. As pent-up demand diminishes, spending on services should ease. Higher interest rates are also expected to continue to slow business investment, and weaker foreign demand will weigh on exports. Putting this together, we expect growth in Canada to stall through the middle of this year before picking up later in the year. We project that on an annual average basis, growth in Canada's GDP will slow from about 3.5% in 2022 to about 1% in 2023 and 2% in 2024. Lower energy prices, improve global supply chains, and slowing demand should bring inflation down significantly this year. We expect CPI inflation to fall to around 3% in the middle of this year and reach the 2% target in 2024. Needless to say, there are risks around this projection. The biggest near-term risk is that global energy prices could increase, pushing inflation up globally. We're also concerned that if inflation expectations remain elevated in Canada or increases in labor costs persist, inflation will not come down as quickly as we forecast. Overall, we view the risks around our inflation forecast as balanced, but with inflation still well above our target, we continue to be more concerned about the upside risks. And if these upside risks materialize, we are prepared to raise interest rates further. Je vais conclure sur quelques messages clés. Les Canadiens sont soulagés de la baisse de l'inflation depuis l'été, surtout ceux qui ont du mal à joindre les deux bouts à cause de leur hausse de la coût de vie. Mais une inflation à plus de 6 %, c'est encore trop élevé. Pour combattre l'inflation, la Banque du Canada a pris des mesures énergétiques. Elle a fait passer le taux directeur de 0,25 % il y a un an à 4,5 % aujourd'hui. Et ça fonctionne. On prend un virage dans notre lutte contre l'inflation. On est encore loin de la cible, mais les évolutions récentes ont renforcé notre conviction que l'inflation descend. Et on est déterminé à la ramener à 2 % pour que les Canadiens puissent compter sur une croissance durable et sur inflation bas, stable et prévisible. I want to leave you with a few key messages. The decline in inflation since the summer is welcome relief for the many Canadians who are struggling to keep up with the rising cost of living. But at more than 6%, inflation remains too high. To combat inflation, the Bank of Canada responded forcefully, raising its policy interest rate from 0.25% to 4.5% today. It's working. We are turning the corner on inflation. We are still a long way from our target, but recent developments have reinforced our confidence that inflation is coming down. And we are committed to getting inflation all the way back to the 2% target so that Canadians can once again count on low, stable, and predictable inflation and sustainable economic growth. And with that overview, the Senior Deputy Governor and I will be pleased to take your questions.
Thank you very much, Governor Macklem. Before we start, I just want to say that we are aware of some feedback for reporters on the teleconference line. I just want to remind everybody on that line to make sure you're muted by pressing *6. Hopefully that clears things up. I'll also say if anybody has joined the call in the last few minutes, a reporter who wants to ask a question, just send us a brief email at communications@bankofcanada.ca, and we'll do our best to get you into the queue. So we'll go to questions now, and we'll start here in the room in Ottawa. And our first question is from Mark Rendell of the Globe and Mail. Go ahead, please, Mark.
Thank you for taking the question, Governor. So the bank signaled that a pause is most likely, but you're still prepared to raise interest rates if needed. I'm wondering if you can expand on what "if needed" means. What would you need to see in order to hike rates again at this point in time?
Yes, as you said, Mark, we raised our policy rate today, and we've signaled that it's time to pause and provide some time to assess whether we've raised interest rates enough to bring inflation back to target. So, what does that mean? Well, what it means is that if economic developments, and in particular, if inflation comes down in line with our forecast, that'll confirm that we've likely done enough. If, on the other hand, we start to see an accumulation of evidence that inflation is not coming down in line with our forecast, we're prepared to raise interest rates further. I want to stress that this isn't going to key off one piece of data or one release. We're looking for an accumulation of evidence, and there, as you know, we follow a whole range of indicators, but clearly some of the key things we're going to be looking for is, we're already seeing the effects of higher interest rates slowing demand in interest-sensitive sectors. We do expect that to gradually feed through more to services prices, which are going to take longer to come down. That's something we're going to be watching. We're going to be looking to see that inflation expectations come down with inflation. And importantly, we're going to be looking to see that inflation is indeed coming down in line with our forecast.
Thank you. We're going to go to Raul from Epoch Times next, please.
Thank you for taking my question. Actually, regarding the housing market, the NPR said that the bank expects house prices to decline further, especially in markets that were red hot. Does the bank have an expectation of what the magnitude of house price declines will ultimately be, whether it's 20% or 30%? And just given the decline in longer term bond yields, especially the 5-year, and that home sales are starting to edge up again, do you see that the downturn in housing overall may be much milder than maybe others might be predicting? There's some positive forces, as you mentioned, immigration and unemployment is extremely low right now, but of course there's still the debt levels.
I can turn to the Senior Deputy Governor for that question.
Yeah, thanks for the question, Ro. I mean, the housing market's really evolving broadly along the lines that we expected it to. Oh, I'm sorry. Sorry, I'll start again with my mic on this time. The housing market's evolved broadly in line with our expectations. As you've mentioned, it's come down, activity's come down significantly, and prices have come down as well. It's important to remember they've come down off extreme highs. We saw a real run-up in prices and activity during the pandemic. That was an unsustainable level of activity. It has come down since then. We do expect, as we outline in the NPR, that pullback will continue in the first couple of quarters of this year. But as you also pointed out, there are some fundamentals that we think will lead to a pickup again later in the year. Immigration is picking up again. So we do expect housing to come back. And you are right, housing costs, mortgages are priced off the bond market in Canada. So as those prices stabilize and come down a bit, we should see that show up in the market. That may have some help in a rebound, but we do think there is a little bit further to go for the housing market to come down a bit.
We'll go next to Steve Shearer from Thomson Reuters, please.
Good morning, Governor. Thank you. Can you hear me?
Yeah. Yes.
In your forecast for inflation today, you say you forecast that it'll be declining to 3% by mid-year and then 2% next year. Since 3% is sort of the upper band of your target, does that mean once you get to 3%, you can start considering cutting, and money markets are pricing in a cut by October?
Well, look, today we've announced that we're raising, and we think it's time for a pause. But let's keep in mind that inflation's still over 6%, and yes, we are certainly seeing clear evidence, and that has reinforced our confidence that inflation's coming down. But look, we do have to be humble. There are a number of risks out there, which we've outlined in the Monetary Policy Report. So it's really far too early to be talking about cuts. The pause really is designed to give us time to assess whether we've raised interest rates enough to get inflation all the way back to target. And I would also just emphasize that the 1% to 3% band is not a zone of indifference. It's designed to give a sense of where Canadians can normally expect fluctuations in inflation. And if you want to be within the 1% to 3% band most of the time, you need to aim for the middle of the band. So our objective is to bring inflation all the way back to 2%.
Thank you. We'll turn now to market news and Greg Quinn.
Good morning. I wanted to ask about the confidence in the view of inflation is significantly coming down. Last year, officials expressed some doubts about your ability to forecast inflation. You abandoned a measure of core inflation that proved to be a little bit wonky. in particular, the view that inflation is of 2%, the target is within sight now. That also seems a contrast with your own survey of consumer expectations, which show a much higher view of prices over that time frame. So where is this confidence coming from that inflation is getting back under control?
Greg, look, I don't want to minimize the risks, and I'll come back to that. But let me start with there are a number of things that are giving us some confidence or reinforcing our confidence that inflation will come down. First is we are seeing evidence that the considerable and rapid interest rate increases that we have put in place are working. You can see clear evidence of slowing in more interest-sensitive parts of the economy, and you can see the rates of inflation on those goods have come down. Secondly, we have had some more favorable developments with global supply chains. Those disruptions are resolving, and in fact, relative to October, they've resolved a little faster than we were expecting. Inflation has come down, and if you look at the 3 month you look at shorter term measures of inflation, 3 month moving average, for example, you can see that the momentum in inflation is cooling. And finally, look, we raised our policy rate 25 basis points today, so we've now got a cumulative increase of 425 basis points. Monetary policy is in restrictive territory, and we know monetary policy works with a lag. And as the effects of those higher interest rates work through the economy, we do expect to see a more generalized slowing in prices. So these developments have reinforced our confidence, but yes, as I said to a previous question, look, we do need to be humble. We are living in a very uncertain world. There's a continued war in Europe. China is reopening rapidly. That could certainly create some upside risks to global commodity prices. Oil prices could go back up. That would boost global inflation. So, as I said in my opening statement, we think it's time to pause, but that is a conditional pause. And we are going to be watching carefully to see if economic developments come out in line with the forecast we put out today.
We'll go now to Kevin Carmichael from the Financial Post.
Good morning. I have a housekeeping question related to the balance sheet. At the risk of slowing the momentum of this press conference, but I thought I'd get it out there for the record. You said last fall, Governor, that you and the government were getting close to some sort of a resolution around the fact that the central bank is on what could be a considerably lengthy period of money losing. Have you come to some sort of resolution on this issue?
Well, let me just begin, Kevin, by underlining that we're here to discuss monetary policy, and the bank's losses have no impact on our monetary policy decisions. But since you've asked, and since our losses are certainly generating some understandable questions, let me say a few things. The first thing I want to underline is that our losses are temporary. Normally, the Bank of Canada makes positive net earnings, and that's because we earn interest on our assets, and we don't pay interest. Our main liability is currency, our banknotes in circulation, and we don't pay interest on that. Through the first parts of the pandemic, through 2020, 2021, with QE, we expanded our balance sheet considerably. We had more assets that created more net income, and we remitted that to the government. More recently, with the increases in interest rates, as you mentioned, the interest we're paying on the settlement balances, that interest rate is now higher than the interest we're getting on our assets, and so our net interest income has turned negative. And we report our financial statements regularly, and as you saw in our Q3 financial statements, that has resulted in our net income turning negative for the first time. We will have a period of a couple years of likely a period of a couple of years of negative net income before our income reverts back to its normal positive state. And as you indicated, or I think as you're aware, in our current legislation, the Bank of Canada does not have the ability to offset losses with retained earnings. We remit all our retained earnings to the government. Second point is, I'd underline, is the Bank of Canada is not alone in this problem. Other central banks that are engaged in QE are also experiencing or will be experiencing losses, and there are various solutions. And as you mentioned, the Bank of Canada and the Department of Finance have been discussing what would be the best solution in the Canadian context. And I can tell you that the Minister of Finance has recently communicated to me that the government intends to introduce legislative amendments that will allow the bank to retain earnings to offset losses. So what this means is it will allow, on a temporary basis, the Bank of Canada to retain earnings rather than remit them to the government for the purpose of covering losses. Once positive equity is restored, we would resume our normal remittances to the Government of Canada. This will, I mean, what I would say is this is a good solution. It'll allow us to manage our equity, and it'll give us all the tools we need. The final part, though, is I do want to go back to where I started. I want to reiterate that none of this has any impact on monetary policy. We don't run monetary policy with a profit motive in mind. Monetary policy, all our policy decisions are guided by our price stability and our financial stability mandates.
We'll turn now to Najud Amalise from Canadian Press.
Hi, Governor. I was wondering if you could talk a little bit about where the bank expects the labor market to head in the coming months. The monetary policy report mentions that, you know, it will start reacting to interest rates over a period of time. And I'm wondering if you could also just weigh in a little bit about your thoughts on maybe whether there was too much fear around the idea of a wage price spiral, given wages have already stabilized and a lot of those wage increases had to do with labor shortages rather than inflation.
Look, labor markets are a big part of the Canadian economy. And to go back to where I started, the economy, you know, growth through the second half of last year was stronger than we expected. It is slowing, but it didn't slow as much as we thought. And you know, one of the things we're seeing is that the labor market remains very tight. If you look at it, it has cooled a little, but you know, vacancies, yes, they've come down, but they remain very elevated. At 5%, the unemployment rate is near historic lows. And certainly companies continue to tell us that they're having trouble attracting all the workers they need. That's a symptom of an overheated economy. And you asked, you know, so what are we expecting going forward? We've raised rates forcefully. We've raised rates rapidly. As those work through the economy, part of rebalancing demand and supply in the economy is rebalancing the labor market. So we do expect to see some cooling of the labor market. We expect it to come into better balance. With respect to the issue of a wage price spiral, with inflation rising rapidly, we have been concerned that inflation expectations could come unmoored, and this could precipitate a wage price spiral. One of the things that is giving us or reinforcing our confidence that inflation is coming down is that, yes, I think the risks of a wage price spiral have diminished. Wage growth is running about 4 to 5%. It looks to have plateaued in that range. In addition, if you look at our surveys when we go out and ask businesses and households their inflation expectations, inflation expectations remain elevated, but fewer people think inflation is going to remain high for a long time. So those expectations at the sort of the tail have pulled in. So both those things suggest that the risk of a wage price spiral has gone down. But what I will say is that wages running in the 4 to 5% range, if that were to persist, if that was to be sustained, that, unless there's a surprisingly strong acceleration in productivity, that's not consistent with getting inflation back to our 2% target. So that is something we will be watching closely.
Okay, next on my list is Kevin Gallagher from CTV, please.
Morning, Governor. I just want to see what your projections are for a recession. Obviously, this might be a bit of a recession by design, since rates were designed to, in many ways cool off the overheated economy. But it does seem like it's a bit of a rosy outlook in terms of the impact. We heard yesterday from economists advising cabinet, that there could be, they wouldn't rule out, quote, hard landing. The projections within your outlook here for 2023 seem to be more of a stalled, almost a soft landing. So what do you think those projections are, given that there will be a slowing of the economy with these measures?
The economy is slowing, and we expect it will continue to slow. We expect that growth through the next 2-3 quarters is going to be pretty close to zero. That is an economy that is stalled. It's not going to feel good. That's basically no growth. We do need this period, though, of essentially no growth to allow supply to catch up. We do need to rebalance. Demand is running ahead of supply. We need to give supply a chance to catch up. That's a big part of reducing the inflationary pressures, and that's a big part of restoring price stability. But I don't want to pretend that it's painless. It's not painless. We've raised interest rates forcefully. That is impacting many Canadians. We are seeing it's working. We're seeing it's working in those interest-sensitive sectors. And we think it will continue to spread through the economy. And once supply catches up with demand, inflation will come down and growth can be restored. With respect to, is that a recession? Is it not a recession? I guess the way I would put it is with a projection of roughly zero growth for 2 to 3 quarters, what that means is it's just as likely that we'll have 2 or 3 quarters of slightly negative growth as slightly positive growth. So yes, it could be a mild recession. It's not a major contraction.
Bon, passons maintenant à Olivier Ferron-Boissé du réseau TVA.
Bonjour, merci de prendre nos questions, Monsieur le gouverneur. Vous disiez plutôt quand vous posez une question à savoir s'il allait y avoir des coupes ou des réductions de votre taux directeur que pour l'instant on était à voir si les hausses cumulatives étaient suffisantes pour faire descendre l'inflation à 2%. Cette cible-là, elle est prévue pour 2024. Donc, est-ce que pour que les gens comprennent bien à la maison, même dans le meilleur des scénarios, il ne faut pas s'attendre à ce que le taux directeur diminue avant 2024, c'est bien ça?
On n'a pas dit ça. On a dit que maintenant, nous pensons que c'est le temps de prendre une pause pour voir si on a assez haussé nos taux directeurs pour ramener l'inflation à 2%. C'est beaucoup trop tôt de parler des réductions des taux d'intérêt. Il y a des risques à la hausse et si l'inflation ne diminue pas en ligne avec notre prévision, on est prêt d'augmenter nos taux directeurs encore. Mais je veux souligner que c'est important, on sait que la politique monétaire marche avec des retards et donc on doit toujours regarder le futur.
Okay, we're just about done here in the room, so I'll thank the people on the line for their patience. I just have Randy Thantong Knight from Bloomberg.
Hi, Governor. Is there a risk that by explicitly signaling a pause that could reignite some inflationary pressure, and are you still more worried about the risk of under-tightening?
Well, I think we did a pretty thorough job of outlining the risks in the report. I think why are we signaling that we think it's time to pause? I think it's pretty straightforward in our own deliberations in the governing council. That was our assessment, and so we're communicating that clearly with Canadians. As I will underline once again, it's a conditional pause. It's conditional on economic developments coming in broadly in line with the forecast that we put out today. And look, if upside risks materialize, if we start to see an accumulation of evidence that inflation's not coming down in line with our forecast, we're prepared to raise interest rates further to bring inflation back to target.
Okay, we're going to go to the phone lines now. Currently, I've got 4 people on the list, and we're going to start with Craig Lord from Global News. Go ahead, please, Craig. Craig, if you're there, it's *6 to unmute. Okay, we'll circle back at this point. I've got Kamutha from BNN. Go ahead, please. Okay. Wondering if there's an issue on the line. Alicia from Yahoo Finance.
Hello?
Hello.
We can hear you.
It's Craig from
Hey,
Global News.
okay, we'll start again then. Excellent. I'm glad it still works. Craig, go ahead, please.
No worries. Thanks for taking our questions. Governor Macklem, you said earlier that you expect the labor market to come back into better balance. A lot of economists have kind of theorized that if there's a mild recession, some businesses would actually be reluctant to shed jobs given today's labor shortages. Would businesses holding on to labor through a recession affect the Bank of Canada's ability to slow demand? And would that potentially force additional interest rate hikes?
Well, look, the labor market is certainly an important element of the information we're going to be looking at. And, as we've highlighted and as we publish on our website, we're following a wide range of labor market indicators. You can't really summarize the health of the labor market in 1 or 2 indicators. I think, look, if the labor market doesn't rebalance, if it remains really tight.
The host left the meeting. This meeting will end in 5.
And that continues to put upward pressure on prices. Yes, that is something we'd have to take into account. You'd probably see that more in service prices. And in one of the boxes in the NPR, we do outline that we're starting to see goods prices or inflation in goods prices come down. That's partly the resolution of global supply chains. It's also partly the monetary policy working to soften demand. It's going to take longer to bring those services prices down, and that rebalancing in the labor market is an important element of getting service price inflation to come down.
Okay, I'm being told now that we've had problems with the phone line and it has been lost. We're hoping at this point I'm going to take a quick tour of the room here to see if anyone's got a quick follow-up while we see if questions are going to come in by email. I know there were at least a couple outlets here who did not get a question on the first round. Okay, I think apparently we're back. Kat Eschner from TVO, are you there? I'm just checking my watch to make sure this is not Friday the 13th. Okay, I'm going to go to Najud, who had a follow-up. while we try to sort this out in the remaining couple of minutes, Najud.
Yeah, as the bank now shifts to a different stage where it's pausing its rate hikes, what communication challenges do you see ahead for the Bank of Canada when it comes to communicating with Canadians about its role in the economy?
Well, I think a few key things here. First of all, 6% inflation is better than 8% inflation, but 6% inflation is still way too high. And Canadians are still feeling the pain of rapid increases in the cost of living. Economic developments have reinforced our confidence that inflation is coming down, but it's going to take us a while to get there, and the economy is going to be soft. I mean, we think growth is going to stall. So this is going to be a tough adjustment. I think the key message is it's working. We do think that the momentum in inflation has shifted. Inflation is coming down. And as we get through that, as we get inflation back down to our target, Canadians can enjoy the benefits of being confident that inflation will be low, stable, and predictable, and we can resume to positive growth. But I don't want to diminish the adjustment that we have to go through to get there. It's going to be worth it. It's working, but there is an adjustment.
Okay, I can tell you we have received one of the questions online by email. I'll just pose it on behalf of Kat Eschner from TVO. She's asking if, Governor, could you please tell more about the range of labor market indicators that the bank is watching to establish what it considers the maximum sustainable level of employment?
Actually, I'll ask the Senior Deputy Governor to say a few words about that.
Turn my mic on this time. Thanks for the question, Kat. We watch a really broad range of indicators, but really at this point, by any measure you look at it, the labor market continues to be tight. I mean, there's a couple of good elaborations of this in the NPR report. Chart 10 is one that we've included for a while now, and you can see a number of data points that tell us that the labor market continues to hover around record highs. The historical low unemployment rate is 4.9%. We're sitting at 5%. Unemployment is below pre-pandemic levels in every province in Canada. So those certainly are key indicators. But as the governor said earlier, there really isn't a single indicator that tells us, without reservation, that the labor market has recovered. So we're going to be continuing to look at this broad range of indicators, and we're going to add that to other data we see. As we've said, the pause that we're communicating today is very conditional on the economy evolving the way we've laid out in our NPR. It took us an accumulation of data to get to the decision that we made today, and to get to the decision to pause, it will take an accumulation of data in the other direction. We need to see momentum turn to come off that pause. But if it does, we will absolutely act the way we have acted continually over the last year to get inflation back to our 2% target.
Okay, I'm going to make one more attempt here. Kamutha from BNN, if you're on and you can hear, please press *6 to unmute and see if you can ask your question. Fingers crossed.
Hi there, this is Kamutha Ramanathan. Governor Macklem and Senior Deputy Governor Rogers, conversations on Bay Street have already started about interest rate cuts. What are the parameters for such a cut? And do you think these Bay Street observers are getting it wrong by discussing such a shift at this stage?
I think it's far too early to be talking about cuts. Look, inflation is still above 6%. Yes, recent developments have reinforced our confidence that inflation is coming down, but we have a long way to go to get back to our 2% target, and we are resolute in our commitment to get all the way back to 2%. As I've indicated, we're talking about a pause, and the pause is really a period to allow us to assess whether we've raised interest rates enough to get inflation back to target. We're trying to balance the risks of over and under tightening. We don't want to underdo it, and then inflation stalls on the way down. So, yeah, to end off where I started, it's way too early to be talking about cuts.
Okay, I've got one more on the line, and I've got one by email. I'm going to ask Alicia from Yahoo Finance if you can unmute by pressing *6.
Okay, thank you for giving me another shot here. Governor Macklem, what's your message to Canadians who are still feeling the impact of high inflation with higher debt costs and grocery prices remaining stubbornly high? How do you want them to think about this conditional pause?
Well, I think the message to Canadians, first of all, is that we know inflation's still too high, and we know that's affecting Canadians. We're acutely aware that low-income Canadians are disproportionately affected by this high inflation. They don't have extra savings to buffer the price increases, and some of the largest price increases have been in essentials, in groceries. Food prices are still going up 11%. Rent is rising. Rent is increasing. These are essentials. These are not things that you can cut back on. So we're acutely aware that Canadians are feeling that. I think our second message is the Bank of Canada has done a lot. We've raised rates now 425 basis points on a cumulative basis over the last year. That is putting an increased burden on Canadians that have high debt loads. That is stretching them. But what we see is that, as these interest rate increases are working through the economy, they are working to rebalance demand. Inflation is coming down. And yes, we're going to have a period of virtually no growth for the next few quarters. But as inflation comes down, the growth will be restored, and it's going to be worth it.
Okay, I had two people actually who were affected by the problems that we had on the line, so I'm going to ask these two really quickly. First, Reed from CBC wants to know, how long can Canadians expect to live with high interest rates?
Look, as I said earlier, that's really going to depend on the evolution of the economy, the evolution of inflation. It's too early to talk about cutting interest rates. We've announced a pause today, and that pause is conditional. It's conditional on economic developments coming out in line with our forecast. If we need to do more, if we need to raise interest rates further to get inflation back to the target, we will. It's too early to be talking about cuts.
And the last question I have, Tony Mace from Mace News, asking what our sense is of how restrictive financial conditions are currently, and how is that affecting our thinking about policy?
Well, we've raised rates cumulatively 425 basis points. We've also we've also reinforced those interest rate increases with quantitative tightening. Together, monetary policy is restrictive, and the best way to see that is you can see the effects of monetary policy. Interest rate sectors, housing, spending on interest-sensitive items like appliances, consumer durables, they are weakening, and we're seeing price inflation in those areas come down. So you can see the effects of restrictive monetary policy working through the economy. And what we're going to be watching closely is how the effects of restrictive monetary policy spread through the economy. It's going to take longer to get to services. They're less interest sensitive, but with pent-up demand for services coming off, with interest rates spreading through the economy, we do expect to see service price inflation come down as well.
Okay, and that will conclude today's press conference. I want to thank the governor and senior deputy governor, and I want to thank everybody for their patience as we worked through those technical issues, particularly everybody on the line. I know we ran a little long, but wanted to get to everybody. Thank you all for your attendance today, and we'll see you next time.
Yes, thank you, and our apologies for the technical problems.